Hey folks, CA Rachana Ranade here, and I welcome you all to a very important video wherein we are going to discuss about the pre-election rally. There are some talks where people are saying that, oh my god, market broke the 19,000 level today, and there are chances that it may slip down further. And there is another school of thought which believes that markets may very well rally from this point. Now we have to understand that if it were to rally, then what could be the reasons behind that? Okay, so what we are going to do today, we are going to try and understand what has happened in the past. We are going to analyze a lot of election years. So we'll get started one by one. And what we are going to do is we are going to analyze the returns that the market has generated in 1 year time frame just before the election. Okay, so as an example, if the election took place in the month of May, then we are going to analyze April, say 1 year before that. Okay, that we are going to analyze, and also 6 months prior to that. So both these time frames, so typically from November to April in that case. Okay, so we are going to analyze two time frames: 6 months time frame, 1 year time frame, and we are going to analyze a lot of election years. So I'm just going to quickly present my screen so that you get to see some data points that I have for you all. So now if you see here, let's get started one by one. The very first one we are going to understand is what happened in 1991. Now here the elections took place somewhere around in the month of June, and that is why we have to understand what happened from May 90 to May 91. And this whole year market gave a return of 63%. And if I were to check just 6 months prior to the rally, then by the way, it is also expected that this now around the corner in the year of 2024, elections may take place in the month of May. And that is why again May is important, and November to May marks the 6 months period, and today is 1st of November. And I hope you are understanding the reason why we are doing this video today. Okay, so now if you see here, for the 6 months time frame, if I were to check, Sensex went up by almost 9.28%, so almost 10%. Okay, same thing we can see here, markets rallied in a 1 year time frame, and here also for a 6 months time frame. Now, if you go ahead for the next election period, that is 1996, here again, same thing, elections happened in the month of May. And again, if I were to track April 95 to April 96, returns were 20.8%. And if I were to understand 6 months prior period, still the returns were around 9.07%. Same thing again, we can see here from the chart. This is the 1 year time frame, and this is the 6 months time frame chart. Now going ahead with the general election performance in 19 and Sensex performance, of course, in 1998. Now if you have understood this, this was a time frame when two or three elections took place back to back. The government was not stable, and whenever the government is not stable, it is generally not liked by the market. The reasons and all these fundas I've cleared in my basics of stock market course. So if time permits, don't forget to check out our website www.rachanaranade.com, where you can see our basics of stock market course, right? So going back to 1998, the elections took place in the month of March 98. So again, we are checking Feb 97 to Feb 98. And here if you see, almost returns were flat, no big returns. Again, political instability was one of the major reasons for that. And if you see here 6 months prior, it was in fact a negative return of 6.5%. And same thing you can see, almost flat. And in fact, last 6 months, you can see a negative return very clearly in the chart as well. Now going to 99, so you can see here 96, 98, 99, back to back elections were happening. And in 99, the elections took place in October, and here markets rallied 1 year prior. The returns were around 51.5%. And if I'm talking about 6 months prior, it was 27.56%. So mind-boggling returns in this specific time frame. And you can see here the rally that can be seen through this chart pattern. It's crazy, right? Now let's go to 2004, and here the elections took place again in the month of May, right? And April 2003 to April 2004, it gave a return of 90.6%. Again, this was mind blowing. But even if I'm talking about the last 6 months period, that is November to the April month, typically you can see here it was 15.26% return. So again, a very good return, I must say. Same thing can be seen here, sharp rally in 1 year, and even here almost 15%. Now, if I were to go to 2009, here you will see a negative return, 1 year negative return of 35.21%. You might be like, why? Asa kasa kai? Reason was very simple, right? It was Lehman Brothers crisis 2008, and because of which the markets gave weightage more to the Lehman Brothers crisis, and the market saw a sharp fall. But if you check 6 months prior to the election, you will again see October to April, you'll see 16.5% return. So October, whenever I'm saying October, it's like end of October, or you can imply that as a start of November also, because November, December, Jan, Feb, March, and April, right? Now going ahead, you can see here same first So year on year, if you see here, it's a fall, but first 6 months was a fall, and last 6 months prior to the election, we did see a rally. Going to 2014, here you can see that if I were to talk about 1 year returns, it was 14.5% almost, and 6 months return were around 5.6%. Same thing again can be seen in the chart. And with that, let's go on to the latest available data, that is for 2019. Now if you see here, overall a year 1 year return was around 11.5%, and last 6 months returns were again 11.28%. Again, same thing can be seen in the chart. Now what we are going to do, we are going to summarize the whole information that we checked till now. Now if you see here, all in all, if I were to talk about a 1 year data, see how many years we have checked right now: 91, 96, 8, 99, 2004, 9, 14, and 19. Now if you see here, all in all, these were the returns barring 2 years. Okay, this is a bare minimum, and this was the crazy fall because of Lehman Brothers crisis. Barring this one, market has given a rally before election. This is 1 year before election. And if I'm talking about 6 months, still 6 months has given a decent enough rally. Now if I were to average out, okay, see, minimal returns were around 5%, 9% twice. Highest year we could see is was around 27%. And if we were to average this out, the average comes to somewhere around 15 to 20%, right? Still, in that case, Nifty on a on a very base side also, Nifty could rally up to 21,000 if we are saying 20% returns. Okay, and Sensex in that case would be 70,800. This is crazy, isn't it? But even if I were to say, chalo, this is 9%, 5% was a minimum, but see, 9%, 9%, even 11% thrice. So even if I were to say 10%, we are at 19,000 right now. 19,000 के ऊपर 10% will still take us to a level of almost 21,000. So I hope you have understood why did I say that there is a chance that markets may rally from here. But is this the only reason? We have to understand one more amazing macroeconomic reason. But for that, you'll have to prepare your mindset first. This is about macroeconomics. I'm going to talk about what happened in Japan very recently. We are going to understand the impact of Japan on US and ultimately on India. So for the next 2-3 minutes, you'll have to pay maximum attention. So for that, let me just share my screen again. Now, if you look at this screen, it might terrify you a little bit, but don't worry, I'm going to explain this in very simple terms. Now, if you see here, what had happened till now was that the Japanese government bond yields were capped, strictly capped at 1%. Their yields, basically. Okay, now why is that so? The government felt that, okay, right now the government then felt that the overall inflation in the country was not that great. In fact, it was more of a deflationary situation, and that is why they wanted to boost the growth in their economy. If the economic growth were to be boosted, in that case, having lower yields, lower interest rates is what is desirable. Okay, and that is the reason why they had kept this as a strict capping at 1%. Now very recently, means in fact yesterday, what happened in Japan is that they have removed this strict capping, and they said that we are using this as a reference for a 10-year Japanese government bond. So what could happen now? Now the yields may go at 1%, may even cross a little bit above 1%. And if that be so, if yields are increasing in Japan, would the institutional investors be more interested in their own market? Possibility number one is yes. Now please understand, till now what was happening is that they even had negative yields. So why would the institutional investors stay back in Japan and invest in their own bonds? Instead, they would want to buy somewhere else. Now, where were they buying? For that, have a look at this one, and you'll be surprised to know that the for if I'm talking about US Treasury bonds, Japan is the largest buyer of US Treasury bonds. Now, understand what could happen if Japanese investors feel that instead of US, let's invest in our own country. What could they do? They may sell the bonds. They may sell US Treasury bonds. If they were to sell, then it will create a selling pressure. More supply for US Treasury bonds, less demand will decrease the price of bonds. Normal economics, right? More supply is equal to more selling pressure. If more selling pressure, then what will happen? The prices of bonds may drop. And if prices of bonds drop, then the yields increase. It's an inverse relationship between price of bonds and yields. Now you'll say, Acha, if yields for US government, US Treasury bonds increase, what is the big deal? Oh, if you have seen my video about Silicon Valley Bank, I very clearly mentioned, I'd also done one or two more similar videos, and in that I had mentioned that currently US banks are facing a big problem because of the sharp increase in yields. They have huge amount of unrealized losses because of this situation. And believe it or not, US banks could be grappling with at least $650 billion of unrealized losses. And this is mainly because of the rising interest rate scenario. This is mainly because of the rising yields. Now, if the Fed were to stop this, if the Fed were to come up with a solution for this, one possible solution could be, in fact, dropping the yields of US Treasury bonds. Dropping yields is equal to, basically, they would have to drop the interest rates there. Okay. Now, if that be so, if the yields become a little bit more unattractive, then for the FIIs, that would mean that instead of parking our money in the bond market, let us park our money in the equity market. And that could be a situation where the FIIs, right now, if you are aware about the fact, right now FIIs are net sellers for the last 2-3 months. There could be a possibility that FIIs may turn to be the net buyers in the coming months, if that be so. And that could also lead to a push in the rally for our markets. So I hope you have understood the whole video, the thought process, why I feel that a bull rally might be on the cards. Two quick reasons as a wrap up. Number one, we said it is because of a pre-election rally, and number two, because of the Japanese situation, our Indian markets may see a positive rally. So I hope you have enjoyed this one. I hope you enjoyed this small dose of economics towards the end as well. If you did, don't forget to leave your comment in the comment section below. And if you have loved this, don't forget to share it with your friends as well. Again, this was an attempt of shoot and release. So show your love by smashing the like button as well. Okay. So till then, take care. Jai Hind and bye bye.